Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is February 21st, 2024. The highlights, the headlines last week were very oriented to inflation and everything that happened with the reports and then the stock market, all tied to these inflation reports. Consumer prices, wholesale prices, and then retail sales, all negative. More negative than they were expecting. The result of inflation, and so what happened is we went up to close to 9% inflation on the CPI, and that has come down quite a bit, down to 4% or between 3 and 4%. And so it looked like that the Fed was not going to have to, lower rates, or they could lower rates and have very little impact on the economy. And but then last week things went back up. They started to go negative. And so now there is a scrambling to figure out what it's going to take. We'll wait and see for inflation to come down, what they're going to do with rates. They were talking about 6 to 7 rate cuts this year. Now they're talking about 3. So I think there's going to be, I think we need to prepare ourselves for the fact that we're probably going to have higher inflation, and that has an impact on the economy, and of course it has an impact on the stock market and certainly the bond market. So anyway, that's wanted to cover that, and now I'll get into the dashboard reports. Okay, first the indexes. These are 6 equity indexes and bonds. The bond ETF index is TLT, the 20-year long-term government bond. So you see in the yellow box on the left, this is what happened last week. Some things went up, some things went down. And then to the right of that is the pink box, and you see nearly everything is positive for the year. There are 3 indexes that are very positive, and 3 of them that are almost break even, and then bonds are quite negative. Those that are positive are the NASDAQ 100, the S&P 500, and the Dow. Those that are much more negative are the small cap, Russell 2000 small cap index, and the developed markets and the emerging markets. Bonds have just been creamed, and so that's a function of rates going up, bond prices coming down. To the right of that, you see the green dots, and all of the indexes are still above their 20, 50, 100, and 200-day moving averages. Bonds mostly below those averages, 3 out of 4. Okay, now I'm going to go look at the component parts of the S&P 500, and you can again see a mixed picture in the yellow box. What was the most negative was technology and telecommunication. Energy was the most positive, and basic materials. When you look to the right, to the far right, you see the green dots and red dots. Again, most of them are still green. We had 5 out of 44 that were negative, so we had 39 positive green dots. That's basically a pretty good sign, but there were some, it was technology that was pulling the market down, and still above its moving averages, but it was not a completely positive week. Year to date, you can see going down in the pink box, going down from top to bottom. Healthcare, financials, still technology because it was so high, and industrials, energy, consumer staples, etc. Okay, this is a picture of the S&P. The S&P went down slightly last week, but you can see the long-term picture or intermediate-term picture going for about 15 months is still in a intermediate-term upward trajectory. I put 3 arrows on here because this is a chart, a relative strength chart, showing the relative strength of growth stocks in the S&P to value stocks. Growth meaning numerator, value is the denominator. So when this goes up, it favors growth. When it goes down, it favors value. So you can see over these periods of time, over months and months of time, the purple line goes from the beginning of 2023 up until, say, the 1st of November. And, or I take that back, 1st of October. And then value took over. From the 1st of October to the end of the year, value was in favor for about 3 months, and growth was out of favor. They just switched places. And then at the beginning of January, they switched places again. Growth took off, value went up, but not as much. So that's what a relative strength chart shows. And of course, this last week, you see the pullback at the very end for growth. We'll see where that goes from here, but it was more of a negative week for growth, more so than value. Same thing, S&P 500, large cap, large companies, relative to small companies, the Russell 2000. So when this goes up, it favors large companies. When it goes down, it favors small companies. So the S&P 500 SPY went up from March to November, and then small cap took over, and it went down pretty straight down, and small cap was in favor. And now at the in December, then went back to large cap. This last 2 weeks, back to small cap. Okay, long-term government bonds, I've covered that some. They did have a run in the last couple of months, 2 or 3 months of last year. Bonds went up, kind of letting off some steam, and they went back up, and they have been falling since that time. So, and I showed you that on the earlier dashboard. And this, bonds go down, generally speaking, or bond indexes go down when interest rates go up, or it is perceived that they're going to go up. And sometimes people anticipate that by going ahead and buying or selling based on what they see happening or potentially happening with interest rates. The dollar continues to go up. It is up in the short term in the last month or two, and it's up in the intermediate term for the past 30 weeks. Gold was weaker last week, the last couple of weeks, and but it still has an intermediate term trajectory. This is an 18-month chart, so over that 18-month period of time, still is in an upward trajectory. Silver has been more volatile, which it typically is, been up and down a lot. But what's interesting is that gold was down last week a little bit, and silver had a very sharp rise to it. So it's interesting to see the divergence of gold and silver. When I compare gold and silver on the relative strength chart, silver numerator, gold denominator, you can see at the very end of the chart that big spike up. When silver outperformed gold that much, it caused a spike up in the relative strength chart. But I'd say still, for the past year or so, it is still in somewhat of a downward trajectory. Bitcoin had a very good week. It's had 2 or 3 good weeks, and it is up, and this is up for the past 15 months or so, and seems to be in an upward trajectory, at least for the time being. Volatility index, because of these reports, the consumer price index, producer price index, retail sales, those and the reaction of stocks, particularly technology stocks, it pushed the volatility index, which is for the S&P 500, pushed it up. So it's down in 14. 24, and it was down in the 12s in the last couple of months. Asbury Research does the Asbury 6, and last week we had 6 out of 6 that were positive. One of them has now turned negative, and we have 5 that are positive. The Asbury Cross-Asset Relative Performance Chart has only 2 items on the entire chart that are positive for both the past week, the last month, and the last quarter. Those are stocks are more favorable than bonds. Even though stocks were mixed last week, they still were more positive than bonds. Short-term bonds are more positive than long-term bonds. Countries, there are 2 countries that have outperformed the U.S. for the last week, month, and quarter, Peru and India. The U.S. has outperformed Mexico, Switzerland, Spain, and Thailand. This is a relative strength chart of the U.S. versus Switzerland. U.S. is numerator, Switzerland denominator, so this shows you the strength of the U.S. market, not the country, but the market in the U.S. represented by SPY compared to the market in Switzerland represented by the ETF EWL. Gold is, spot price is 2015, and that is down. You saw it in the previous chart, down slightly, so it's down 0.5% from the previous Friday. Silver, you saw the spike up on that. That was a 3.3% increase in the price of silver, taking the spot price to $23.48. The gold-silver ratio is 89-1, favoring silver as a better buy. A monster box of 500 rounds of generic silver now goes for $12,365. That's $1.25 over spot price. Now, I've been quoting the markup, at least the markup that my son uses, and I think that probably is representative of others, but I don't know that. But his markup has dropped from, what was it, $2.24 last week down to $1.25. Now, I remember buying gold a long time ago and paying something like that. I remember going as low as $1, but $1.25 is definitely lower. So that showed to me not so much the price of silver or gold, but the markups is what tells you where the demand is. So it tells me that for right now, the demand is slacked off, which gives buyers a better opportunity. So the price per round in 500 quantity is $24.73, including the markup, and the price per round in a tube of 20 is $25.23. I've shown this before. Gold is money. Everything else is credit. J.P. Morgan, 1912. And J.P. Morgan Bank is a very big buyer of gold. And actually, some people think that they actually are manipulating the price of gold or highly influencing the price of gold. But gold has, and silver, have intrinsic value, and that's why I like them. And of course, I've said before, I buy silver and not gold. I've bought gold before, but right now I'm buying silver. So something to think about. I don't get rid of my US dollars, but I do have some money in silver because it has intrinsic value. Thank you for watching. If you have questions or comments, leave them in the comment section below.